Welcome, everyone. Tom Dixon here, right on time. We said we would start at 12 o'clock Eastern, and guess what? We're doing that. So really delighted you can join us for what I think will be a very interesting session with Professor Jim DiLelio, and hopefully I'm pronouncing that correctly, Jim's last name. Jim has really done some great work in the area of retirement income and really optimizing outcomes for clients as it relates to tax efficient withdrawals, right? So really delighted to have Jim here to really, it's in my view, sort of walking through a paper that he put together and a lot of work that he's put together around this issue of seeking tax alpha. And I'm going to say finding tax alpha in retirement income. So really delighted to have Jim. He's a distinguished professor at Pepperdine University out in the sunny land of California. Yes, I'm a little envious, I have to confess, but really, again, delighted to have him here. With that, Jim, thank you so much for joining. I am going to hand it over to you, and you should see the pop-up appear.
Okay,
so
I think it's up. Great,
yeah.
So let me see if I can make that bigger. Well, wonderful. Well, let me start by thanking you for inviting me to this opportunity to present some of my most recent research, and then how I've turned some of that research into practice and made it available to a larger community. This has been a research project that I've been engaged on for, coming up on probably 10 years. In the academic sense, it's a fantastic problem in the realm of optimization, but has incredible relevance, as I know for many of you. So the title of my presentation here is Seeking Tax Alpha in Retirement Income. And again, my name is Jim DiLelio. This is just a little bit about me. I'm an associate professor of decision sciences at the Grazie Dio Business School at Pepperdine University. And I certainly want to highlight this asterisk. Everything I'm saying here is solely the views that are presented are mine. They're not those of the university. So I have my doctorate in applied mathematics from Northwestern, and I also have my MBA from Pepperdine. In fact, for those of you that are on the East Coast time zone, I can certainly relate to some of the weather you've been having recently. I grew up in that weather. I grew up in Northeast Ohio, made my way to Chicago for graduate school, and then just kept heading west until I got to California for where I began my career. My current research interests and focus are in the area of tax-efficient algorithms for retirement income. So it's really what decisions can be made to squeeze out that additional efficiency. And just a couple of years ago, I founded a site called ETF Math Guy, which is a subscription education service for tax-efficient investing with exchange-traded funds, which is also a thread of research I've been strongly engaged on in the most recent years. Let's see if I can go ahead and page to the next one here. So here we go. So some resources available to you since you will have access to this presentation. If you just want a copy of the presentation, I believe that's already been made available to you from Tom. I have also written an extensive white paper over all of the results you're going to see here. That's sort of a prerequisite as an academic. When I publish articles, they go through a peer review process that implies a lot of academic rigor, and that academic rigor typically involves much more detail than what I could provide in a presentation like this. So for those of you that might have interest, you're welcome to take a look at that. That's actually an article that's out currently for peer review, and hopefully will be published in the near future. And then the results you'll be seeing today are from my online calculators. So this is where I really felt strongly about bringing some of the research that I had from my desktop to anyone who might want to have access to it. So the common rule is a very, very useful approach in developing account drawdowns in retirement. And I've already set that up so anyone at any time could go ahead and run the calculations and see the results. And then I also provide the option of updating a profile to help expedite some of the calculations so you don't need to input so much each time. The optimal results that I'm going to show you, I am making available for subscription on an annual basis. So I encourage you to check that out. And I've decided also that this is really feeding into a larger area of personal financial calculators that I see is a little bit of an open area still out in practice, not necessarily drawing on some of the greatest and latest research that's been going on. So I am going to be building upon that. Also, you'll be seeing me present 2 case studies. I call them case study 1 and case study 2. For those of you that want to actually download and see the reports that I generated from those in their entirety, these are the links to them. And then, of course, you can also always reach me. I set up this separate email address. You're more than welcome to contact me with any questions or any feedback you might have. So let me continue on in the presentation. So let me give you a summary of what we're going to talk about here. So we're really going to talk about, begin with a framework of how to find an optimal decision for tax efficient income. And by optimal decision, I mean in what sequence, in what order, in what mix can you draw down assets from various accounts in a way that is tax efficient, such that either the portfolio longevity is increased or the amount of assets you're transferring to your heirs, whether those are individuals, whether those are kids, whether those are a charitable organization, that those are maximized. So that's the objective of this optimal decision. So by developing a model for income and capital gains tax with stock and bond investments in tax exempt, tax deferred, and taxable accounts, I've identified 3 categories of retirees based upon their income needs and net worth. And I'll talk a little bit more about what those categories look like in just a moment. I then developed and evaluated what I call a simple heuristic. The heuristic is important because behind the scenes, there are quite a bit of calculations that are ongoing, and you want to do it in a way such that it leads you to the correct result. The heuristic actually comes from the common rule. So I'm not suggesting we throw out the common rule. In fact, I think the common rule has a really good basis in developing intuition on the right beginning point. But certainly there is opportunity for improvement. And I'll show you that improvement is anywhere between 50 to 80 basis points per year throughout the retirement horizon. I call that term tax alpha because that is basically the result of the additional return you're getting, that additional portfolio longevity, or that additional assets being transferred to an heir. And what's interesting about this is that it encourages you to pay taxes a little bit early. This is contrary to a lot of common wisdom advocated by pretty much every accountant I've ever spoken to, most of the accounting literature I've read, which is always defer taxes for as long as possible. Here it shows there's clearly a strategic benefit. And this is something that I think has been recognized for some time now, at least within academic circles. I see it also being recognized in practice, but really I'm going to show you how we're going to quantify that very clearly based upon a set of models and assumptions. And then we will illustrate that seeking an optimal decision for retirement income requires really different strategies. It depends upon the situation that the retiree is in. So some of the learning objectives of what you'll see here, I'm going to begin by just simply reviewing the common rule for retirement account drawdowns. Just to make sure there's no doubt about when I talk about the common rule, what is it that I'm referring to? Sometimes it's also called the conventional wisdom. I've heard it by a couple names. The common rule is actually a term that was originally developed in some of the academic literature, so I'm actually using that as my fallback as a reference. I'll also identify where the common rule can be tax inefficient when you have some knowledge of the heir's marginal tax rate. So things like 401k accounts, things like traditional IRAs, if those are not used, those will ultimately be transferred to an heir. Well, the heir is still going to owe some taxes on that, and I'll be able to identify where that inefficiency lies. I'll help you understand how a simple heuristic to categorize the retiree's assets into either insufficient assets to support retirement, sufficient or excess, and that will be based upon not only the income needs of the retiree, but their retirement horizon. And then lastly, the final objective is learn why there is a strategic benefit to paying taxes earlier, particularly for a retiree and spouse with a large age difference. So if you've heard the term the widow's penalty, that's something that happens because when someone loses their spouse, future years of tax filing are going to be filed as a single individual in most cases. And under that situation, if they were previously filing with the standard deduction, well, that standard deduction just got cut significantly, and that has an impact, obviously, on their taxes. So here's our first polling question. I'm going to hand it back to Tom so he can go ahead and run this for you all.
All right, folks, this is again the first of 3 polling questions, and you'll have a pop-up window appear in 5 seconds. Let me just read through the question, then I will initiate that. One of the learning objectives of this webinar, today's webinar, is A, review the common rule for retirement account drawdowns, B, survey all optimal account drawdown strategies, C, analyze how to optimize Social Security benefits, D, discuss proposed legislation that may change future tax laws. So again, here we go. Again, you should have a little pop-up window. If you don't see that appear, you may need to minimize the presentation screen. So we'll give it, let's give it 15, 20 seconds for you to participate, and then we'll go back to Jim. Okay, let's give it 3 seconds. 2, 1. We had good participation, Jim. 69% Jim said A, review the common rule for retirement account withdrawals. And Jim, before, so and that's a correct answer, right? Jim, before I hand it back to you, we also had a question with the resources. Gail was asking if there's just one site that she or anyone else could go to get the white paper and some of the other resources that you had. If not, that's okay. I know we're going to direct them. You're going to direct them to the calculator site, but is there any other site they should be aware of?
So yeah, the white paper, I believe I put it on the site. I'd say for right now, probably your best reference is just simply that that document, that PDF document that you shared with everyone, because it has it all on that one single page.
Okay.
But yeah, in terms of a website, I don't think I would have to double check to see if it's all been consolidated onto my website. It probably is, but I would have to confirm that. Certainly, if there's any resource that you see that's not available, I provide my email address there. You're more than welcome to reach out to me. I'd be more than happy to provide it.
And I'll be glad to put it on the webinar replays page, Jim. Post session, we can put it all on the replay page. So okay, back to you.
Great, thank you. Okay, let's see if I can get back to the presentation. Let's see. All right, so that was our first polling question. So I also want to step back for a moment and say, what is tax alpha, right? Alpha traditionally is from the capital asset pricing model that I'm sure many of you are very aware of, right? You calculate a beta, you calculate an alpha. It actually comes from the realm of regression analysis. It's actually a topic I teach my students. In fact, I'll be teaching that in a couple of weeks. I actually use CAPM, but tax alpha is a little bit different. I'm actually defining tax alpha because I haven't seen a specific definition of it within the literature. I've certainly seen some use of it among academics, but I want to make sure it's clear how I'm going to be expressing this term tax alpha. And so here I'm going to be defining tax alpha as the additional annual investment return necessary for the common rule withdrawal strategy to meet the same portfolio longevity or bequest as an optimal strategy. So for instance, if you had a strategy that had a longevity of say 35 years based upon the common rule, and you came up with an optimal strategy that could stretch the portfolio to say 40 years, then there was some tax alpha, some additional return if you had used the common rule that could also get you to the 40 years. That's what I'm defining here as tax alpha. And as I mentioned before, it's anywhere between 50 and 80 basis points. Might be a little less given certain situations, or in fact, I've actually seen instances with a financial planner I was working with here in California where they actually had it over 100 basis points, so a little over 1%. That might be a little bit more of an extreme example. So that's tax alpha. I do have one equation in this set of slides. For those of you that really like to see the equations, I encourage you to download the white paper. You will see quite a few. This is just one from them, from that white paper and from what I've developed in terms of this model. This is what we call in academic circles after-tax objective function. So the after-tax value of an estate, I'm defining as whatever the value in the brokerage account is. And of course, this is after tax, so I'm assuming there's a step up in cost basis for the heirs. And then you've got a component associated with the tax deferred accounts. So think 401ks, 403bs, traditional IRAs, anything that was funded with pre-tax dollars. Notice there's a component here of the heir's tax rate. So the heir, assuming they're not a charitable organization, they're going to owe some marginal taxes on that. So that is the reduction of those what the heir is going to receive there based upon their tax rate. And then, of course, tax exempt accounts. Think Roth IRAs, Roth 403Bs, anything that is going to be exempt from taxes. Of course, the heirs will receive that, and there's no additional taxes that would be imposed upon them. I also include this term C here. Think of C as simply a constant. That constant, if the accounts are liquidated immediately, I'm going to assume that constant is 1, which is okay. The heir liquidates their inherited IRA, their inherited Roth IRA, and so that means they get the value. And of course, for the IRA, it's going to be less the amount of taxes they owe on it. However, there is an opportunity for those heirs, to stretch out the inheritance. Right? The Secure Act provides for a 10-year window, and in fact, some fairly recent research, and this is actually the link to that research, shows that you get about a 14% bump in present value if you're willing to stretch out those drawdowns over the 10 years. So something that an heir might want to consider, just in order to continue to get some of that tax-deferred benefit. So that's also included in the model. Here is a stacking for how I model income taxes and capital gains taxes. This is important because it does clarify and show you how things like the deductions, how elements of income are taxed as ordinary income, how they're taxed as capital gains, and of course, what I call tax-free income, other sources that can go towards a retiree's after-tax income. So from the bottom up, you have things like Social Security benefits. You have taxable bond interest. You have pension benefits. I'm assuming those are all taxable as ordinary income. I should highlight that the Social Security benefits here, my model is assuming that that's 85% of Social Security benefits. There are ways that if you have a small enough adjusted gross income, it in fact could be a little bit less. My model is assuming that it actually meets that threshold. So that's an assumption that goes in here. Social Security, taxable bond interest, all taxed as ordinary income. In this case, I show, well, if your standard deduction or any total set of deductions are larger than that, that effectively is tax-free. Then you would have some of your tax-deferred account withdrawals. So anything that's in green are decisions that the retiree is going to be making based upon their withdrawal strategy. What's in blue is going to be just other income that's available for retirement. So for instance, you're going to have these pension benefits, potentially Social Security benefits. I just call that other income supporting retirement income. You could have municipal bond interest. You're also going to have an element of tax-free Social Security. So once you've made the decision, or the retiree has made the decision to receive those benefits, that money is just going to come in year over year. Okay. The decisions are then how much tax-deferred account withdrawals do you take, which are all going to be taxed as ordinary income. You have some qualified dividends coming out of your taxable account that are going to be taxed like long-term capital gains at the preferential rates. And then you have some drawdowns from your brokerage account, a taxable account. Some of that's going to be based upon the gains, and some of that's going to be based upon the principal. So if anything that's at the basis is going to be able to be drawn down effectively tax-free, and anything that was a gain is going to be taxed as a capital gain. And then last but not least, any withdrawals from a Roth type account, or Roth 403B, or Roth 401k, of course, that's going to be tax-free. So this is how I break it up and show how they sort of stack on top of one another in terms of the model. And now we're on our next polling question, so I'll hand it back to Tom.
Great. Thanks, Jim. All right, folks, here we go again. You'll see a pop-up window in 10 seconds. In the model for income and capital gains taxes, how are qualified dividends taxed? A, they are not taxed. B, they are taxed as ordinary income. C, they are taxed at long-term capital gains tax rates. D, they are taxed only when AGI exceeds $200,000. So here we go. Again, you should have a little pop-up window that appears, a second window. please use that window, not the question box, to participate. So I hope folks like the polling questions. We started them, about a year and a half ago because of the CPE requirements, and I just think it's really a nice feature. But as always, I welcome feedback. I'd love to add more polling questions, frankly. All right, let's give it 5 more seconds. 3, that's a slow countdown. 2, all right, folks, one more time. 1, all right, here we go. Okay, Jim, you will be pleased to hear that 77% said C, they are taxed at long-term cap gain rates.
Fantastic.
All right, back to you.
Wonderful, thank you. And in fact, this is actually something I'm glad we were able to bring it forward as a polling question. I will say, somewhat surprisingly, a lot of the academic literature that's gotten into this area has either said, well, we'll just assume it's at a fixed rate, or we'll assume there's no taxation, or we'll just lump them in with ordinary income, which might be an approach when some models were initially developed. But given the sophistication of the models that have been developed by academics, and certainly the models that are preferred to be used in practice, you want to have that additional fidelity. So the qualified dividends should be taxed in the way that they actually are taxed based upon our tax law, which means at the long-term capital gains tax rates. Fantastic. So this is an image from my white paper where I try to categorize the need for a heuristic. And what I mean by a need for the heuristic, to be an indication, so how can this algorithm that's going to perform the tax efficient withdrawal decisions, how should it move forward? Because it depends upon the situation. So there's basically 3 situations, and I'll just walk through those situations here from top to bottom. And let me see if I can bring my mouse back. Oops, don't want to go there. Well, so from the top left, so let's talk about the axes first. So the horizontal axis is the net worth plus any present value of annuities. And here I'm talking about annuities are fixed payments, like from a pension or from Social Security. I'm not thinking of annuities necessarily in the life insurance perspective, but just you have a stream of income. So there's going to be some present value of those. And you're also going to have some net worth. This is some, if you were to add up all of your account values, associated with all your accounts, you're going to have some amount of dollars there on the horizontal axis. And on the vertical axis is going to be your retirement need, some kind of income need. It's $100,000 a year, $150,000, $75,000, whatever that number might be per year, times your retirement horizon. So in the top left is the retiree has insufficient funds. So this would be an example of someone who doesn't have a very large amount of savings in their accounts, maybe has little or no, well, maybe has a very small amount of annuities. Maybe they just have Social Security and it's maybe not very much. Yet they think they're going to live on the vertical axis a really long time, and they really want a lot of retirement income. So in that situation, the retiree is most likely going to have insufficient funds. They're going to effectively run out, and they're going to have some portfolio longevity that is not as long as their expected lifespan. Then you have sort of the middle region, which turns out to be a bit of a sweet spot from what I discovered in my research, which is the retiree has what I call sufficient, but not excessive funds. And what I mean by sufficient, it means year over year, they can certainly support their retirement income needs that they've set forth, and they have sufficient assets as well as whatever fixed payments coming in to help support that, but not quite to the level of the lower right. The lower right is what I call excess retirement income. So I guess this is the best situation to be in as a retiree from a risk perspective, because here you have a retiree who has, a retirement income need of, I don't need a lot of money each year, and maybe my health isn't so great, so I don't think I have that many more years remaining, yet I have a lot of assets. And I maybe have a very generous pension, and I get a good amount from Social Security. And so in that case, just the interest from some of the investments, imagine they just have a taxable account, and that taxable account is generating just on interest, $80,000 a year, but their retirement income needs are only $50,000. So this would be a situation where the retiree has really very little, if any, significant risk in supporting their retirement income needs. So these three categories are important because that's actually a way I'm going to distinguish what optimal strategy is going to be used. And I basically call these either a modified version of the common rule or what's called the sequential least squares programming technique, which is an optimization technique that's been used by academics as well as in practice across a variety of different industries. Here's a review of the common rule sequence for those of you that maybe aren't as familiar with it. It begins very simply with you draw down from your RMDs from your tax deferred accounts. Without drawing down those RMDs, the penalties are significant. In fact, in some areas, I've actually seen it said it's a requirement. My interpretation is that it's not necessarily a requirement, but from an optimization perspective, the penalty is far too large. You always want to take your RMDs from your required minimum distributions from your tax deferred accounts. Then the next step is once you've done those, if there are any, or if there are, you've taken them, then you withdraw from your taxable account until it is depleted. Okay. Once it's depleted, then you move on to your tax deferred accounts. Then you move on to your tax exempt accounts. So it's truly sequential. You go from one to the next in each of these steps. The key here in the optimal withdrawal strategies that you're going to see is that they're not sequential, but they mix accounts in order to do one of two things: maximize the portfolio longevity or the bequest to the heir. Oops, that is the wrong direction. So here's the first of two case studies I wanted to share with you. These are obviously fictitious names, Steve and Alice. Let me see if I can bring this back. There we go. Let me just move a couple things out of the way here. Steve and Alice, they can increase their portfolio's longevity and reduce the widow's penalty. So here I say Steve and Alice retired this year in a community property state. Community property is relevant in the model because in the taxable account, I'm assuming that when the surviving spouse receives the assets from the taxable account, that they do get a step up in cost basis associated with a community property state. For non-community property states, there is still a step up that's only half of it, and my model includes that aspect as well. So we're assuming Steve is actually much younger, but has another 35 years in his life expectancy. Alice is noticeably older with the same life expectancy. They have after-tax retirement income needs of $120,000 per year, and those are in today's dollars. They both have RMD starting at age 72. The heir's marginal income tax rate is 25%. Steve and Alice both have retirement assets, and I list what those assets are here. Neither of them have any type of Roth type accounts or tax exempt accounts. Steve has a taxable account with a cost basis, which is given here. I also assume they start with a 60-40 split of stock and bonds in all their accounts, and they follow a glide path approach, which is every year they're going to go ahead and increase their bond allocation by 1%. The model I have actually allows you to either not change that, you can increase it faster, or you could even go in the other direction. I've gotten feedback from some financial advisors that say, you know what, I actually want to go the other direction. I want to get more aggressive in maybe some of those later years. So however you want to handle that, the model can certainly accommodate it. And then lastly, we have some information here about pension and Social Security income. So this is a very summary level. I'm going to show you a more detailed report that actually comes out, but this is sort of the big picture of what comes out of the model. And here's my first pointing to you to, you can run any of these models as little or as much as you like, completely free. You just click on this link. It'll take you to the site. And so let me walk through what is really quite a bit of information that you're going to see here. What you're seeing in the left chart is the results of drawing down from the common rule in order to meet, in this case, the $120,000 of retirement, after-tax retirement income sought by both the retiree and their surviving spouse. So that's what you see here. Now you'll see it's nice and flat, which means we're basically adjusting things in the future. So this is all in current year dollars. Because tax brackets are adjusted for inflation, I'm assuming they're basically flat over time. And that's a common approach used that I've seen both among academics as well as those in practice. So that's why all your tax brackets, you can kind of see them here, these dashed lines, they all stay flat. And at some point they drop down pretty significantly. That drop down occurs, in fact, when the surviving spouse is only remaining that. After their spouse passes away, they're now under this filing as a single for their tax returns. On the horizontal axis, you just see it's the retirement year, so the first year of retirement, the second year, et cetera, all the way out to 35 years of retirement. And you'll see the age of the retiree and the spouse, 61 and 72 at the end of the first year. Okay, and what you see in the first year is that the retirement income comes through a combination of bond interest, pensions, and Social Security. And that's the Social Security that's 85% taxed. That's in the light blue. There's a small amount of RMDs in those that first year. Gray is your stock dividends, which again are going to be taxed at the long-term capital gains rate. And then what's in orange here is the taxable account. So remember, the common rule says you should really draw down from the taxable account. So, whoops, go back there. So what you see here, this is trying to exhaust the taxable account. And it does that until it looks like about year 10 when the taxable account gets exhausted, and then it has to switch over to the tax deferred account. Okay, so the tax deferred account starts to be used in order to support the income. Of course, things like the pensions and Social Security are starting to kick in, which is why these are stepping up. And these yellow lines, those are the RMDs where it looks like it's not a constraint here. The retiree under the common rule is going ahead and drawing down in order to meet those. So, but what you can see happens is they start drawing those down, but then there's a surviving spouse, and now you're still drawing down and you're paying a lot more in taxes. In fact, you're into the 24% tax bracket in these later years. Anything then that's in red, that means you've basically exhausted your resources. So in this case, the portfolio lasts until about the retiree turns age 90. So they're not going to make it to 95. However, if you take a different approach, which is instead of only consuming from the taxable account initially, you mainly consume from the tax deferred account, which is the blue here. You can see RMDs are almost a non-issue because you've drawn down that account much more significantly. And in fact, the portfolio lasts a lot longer. In fact, it gets almost out to the 95th year. The big picture here is it increases the portfolio longevity by a little over 4.5 years, and the equivalent tax alpha, or the additional return that the common rule strategy would have needed in order to generate the same longevity, would have been almost 90 basis points. So I want to actually pop out of here for a moment. One of the resources that I provided to you is actually this as a case study. Let's see if I can make this a little bit bigger. This is just basically a PDF printout from the site that not only walks you through, this is the summary of the plan. It gives you a little bit of a narrative of what's going on, talks about some next steps. These are the two images I just walked through, but to help support, how did this data come about? You can see what the tax liabilities look like. So in the case of the common rule withdrawal strategy, you can see that, yeah, there weren't a lot of taxes paid initially. The taxes get more loaded into the back, and they, as you can see, quite substantial in those later years, above $25,000 a year for that surviving spouse. However, if you're willing to pay some of those taxes earlier, then the taxes later become much less to the benefit of the retiree. And then you can see exactly what happens with the account values, whether you use the common rule, or in this case, the modified common rule, in order to stretch out that portfolio longevity. Of course, the portfolio still run out of money, so I do list what the account balances are here. They both end up at zero in both cases, but you can see the difference here is that it really holds off on using the dollars from the taxable account until much later, versus here, the taxable account is drawn down immediately. What you'll also see from a very pragmatic perspective is, okay, if you want to use this optimal decision, what does it look like? You see there is a first year retirement decision, which is how much do you pull from your taxable account? It says, well, you shouldn't draw any. How much should you pull from the tax deferred account? Well, you should pull about $109,000, which after you pay taxes on it will give you this after-tax amount. I should emphasize this is the marginal tax. This is the tax on addition once it's stacked on top of those other sources of income. There's no tax-exempt account withdrawals. There is some bond, coupons, pension, Social Security, which because they don't exceed the standard deduction, there's no taxes on it. There are some taxes on the stock dividends, and there is some tax-free Social Security. So what you can see from this is, yes, your pre-tax income is going to look like 137. And then just as a reference, this is all using the 2022 tax laws. So I show exactly what those rates that were included in the model, along with what the standard deduction was for both the case of married filing jointly, which was the 1st through 24th years of this retirement plan, and then for the single filer, the surviving spouse for the remaining years, what those look like. And of course, this is all in current year dollars. And then I provide some additional background information as well as a disclaimer. So lots of information. I didn't put all that into the slides, but anytime you run this model, it will give you the ability to see all of that information. So that was the first case study. Here's another case study, which is, okay, maybe you don't run out. Maybe you, in fact, have an opportunity to increase your heirs' inheritance. So here I have another couple who is, again, in a community property state. Oops, let's try to go back to there. Let's try this again. Sorry about that. There we go. So they're in a community property state. Here, there's actually less of a difference between their ages. I'm assuming that John's a little older at 65, Jane's 62. Their life expectancies aren't quite as long. Maybe their health isn't quite as good. Whatever the case may be, they're not expecting to live quite as long. But they have higher after-tax income needs. They want to spend a little bit more of their nest egg. And they also recognize, whoever the surviving spouse is, in this case it would be Jane, probably not going to spend quite as much in today's dollars. Their RMDs kick in at age 72. They have an heirs marginal tax rate, and they have a fair amount of assets in both tax deferred, tax exempt, and a taxable account with some cost basis. The asset allocation is much like what I just did, and there is an element of pension and Social Security. I should mention also that the assumption is made that Social Security is being adjusted each year for inflation. So that basically keeps up with inflation. The pension, I'm assuming, does not actually keep up with inflation. That it's fixed in today's dollars, and so that in future dollars it's actually worth less and less. So here again is the snapshot, the big picture. What does it look like for that 20-year retirement horizon? Well, initially, if you follow the common rule, you're only drawing down from the taxable account. So that's this orange piece. There is some from the taxable account qualified dividends, and of course you have other bond dividends and maybe a little bit of pension and Social Security that are also available to the retiree to meet their $150,000 of after-tax income. It's not until much later that they actually draw down all the taxable account, but along the way they run into this issue with the RMDs, which is, at age 72 they have to start drawing down the RMDs. In fact, here's the age 72 of the spouse. She has to begin her RMDs. So what you see in these yellow lines through the blue bars is RMDs that have to be taken. So even though the common rule says you should be drawing down from the taxable account, remember the first step was make sure you also take your RMDs. So that's what you see here. These RMDs are requiring this happen. And of course, because they require it, they are reducing it, but not very significantly. And what happens is the surviving spouse, again, takes a bit of a hit tax-wise. So these are the tax brackets, which you can see here. By the way, this tax bracket in this color is actually anything above this would be ones that would be tax inefficient to give to the heir. That if you wouldn't want to spend above this amount, you're better off actually giving the dollars to an heir at that point. So this is what it looks like, but tax efficiently, this is not terribly tax efficient because you're paying quite a bit of taxes in these later years because that surviving spouse is now needing to file their taxes as a single individual. So this is the optimal rule. This is using the sequential least squares programming approach. And what it says is that, in fact, you actually are really now mixing. You're going to take some of that interest. You're going to, of course, get your qualified dividends, but you're also going to get your tax deferred account, and you're actually even going to draw down a little bit of your Roth asset just to keep your taxable income just a little bit lower. And you do that throughout the years. You don't even let the taxable account creep in until later years. RMDs are no longer even an issue. They're no longer pushing you up. But most importantly, in these later years, the retiree, the surviving spouse, is not getting hit by the larger tax bill. What that means is over $250,000 in after-tax current year dollars will be going to the heirs. Again, that's after-tax, so it assumes whatever tax-deferred account money has already been taxed, and the equivalent tax alpha of around 55 basis points. And we are now at polling question 3, so I'll hand it back to Tom.
All right, Jim, thank you. And Jim, don't let me forget to initiate the survey for you as well. I will post that again in the chat room. So, okay, folks, last polling question for now. The widow's penalty refers to A, the surviving spouse no longer receiving a spouse's pension benefit, B, the surviving spouse no longer receiving a spouse's Social Security benefit, C, the surviving spouse living in a community property state, or D, the surviving spouse filing taxes as a single instead of married filing jointly. So here we go. Again, you should see that on your screen. Please use again, the pop-up window to participate. And from here, I think we're almost at the end, and we're almost to Q&A, folks. So we have a lot of questions, Jim, as typical, and I'm sure we'll try to zip through them as quickly as possible. All right, let's give it 3 more seconds. 2, 1. Admittedly, I'm not a Swiss clock. Okay. All right. Let me bring that to a close. And Jim, 94% answered filing taxes as a single instead of filing jointly.
Wow, I think the scores are trending upward.
Yeah, we are. That's good stuff.
Well, thank you for letting me know. There's quite a few questions coming in, Tom. I only have a couple more slides, and then I'd be happy to take questions. So let me see if I can get this back to the presentation. Let's see. Let me see if I can bring that back up. Okay, so that was a polling question. So I'm actually nearly done. In fact, I think I only have this is my second to last slide, and then we can open it up for Q&A. Here, one of the things I thought I would just list for you, just for your reference, is what is this model currently doing? Like any kind of financial model, you know, sort of the devil's in the details. So I listed some of those here. So for example, I'm looking at either maximizing an heir's inheritance or the portfolio longevity. I'm looking at everything on after-tax income needs. I am looking at cost basis information in the taxable account. That includes a stock and bond mix. I do include RMDs for both the retiree and the spouse, and those RMDs are based upon the Secure Act. So I believe it in June 30th of 1949 was the cutover when RMDs switched from 70.5 to 72. The model does accommodate that, whether you fall under the previous category or the current RMD schedule. And I mentioned that the effect of the 10-year stretch IRA on inherited wealth. I didn't really touch upon this, but one of the areas that I get into a lot in the most recent paper, which is an area of great interest, is the effect of increases or decreases on future tax rates. So the Tax Cuts and Jobs Act is set to expire. It depends upon what Congress decides to do with that in a few years, and whether taxes go down, whether taxes go up. There is currently an input to the model where you can actually go in and say, well, I'm assuming tax rates will go up by this percent or go down by this percent. You can actually see the effect on it. The short answer is the more taxes go up in the future, the greater opportunity for tax alpha exists. I include the step up in cost basis for community property. I am looking at federal income and capital gains tax rates as of 2022. Social Security benefits adjusted for inflation. Pensions are not. Social Security and pension benefits initiated at whatever age you select. I'm not trying to optimize Social Security here. I quite frankly think that Mike Piper's calculator online, which is free, does a fantastic job in helping make that decision. So I would certainly refer you to that. So I'm not trying to optimize it, assuming that input is given. And then, of course, I have a graphical display of all of that information. And I have a link here for frequently asked questions of a lot more detail. So kind of looks like you already posted it. I am seeking input on what new features or additional options would you like to see in this kind of software. So if you're interested in it or you'd be willing to provide me with your feedback, I really do get a lot out of hearing from those in practice. Where is it most relevant for you? Not only do I think it helps the software better, but quite frankly, as an academic, it helps me guide my research. I can better understand what's going on in practice to help make sure that my research is as relevant as it can be. And that's it. That's actually all I had. I want to thank Tom for having me here as part of this webinar. I want to thank you all for your attention. And I'd be more than happy to answer any questions that anyone might have at this point.
Okay, Jim. Yeah, great. Thank you. And let me scroll back up to start the questions. But again, what I posted in a response to Marion's question and is a link that Jim provided to that survey, and he's essentially looking for input in terms of new features and what he might add to the calculator. And please know this is really the basis. This drives or informs his research. So he's not here selling anything or whatever. This is really, I think, a unique opportunity for you to take advantage of a tool that's really the byproduct of his research, but again, and also to have the opportunity to influence what he might consider going forward. So again, if you did not see, the survey link was in the reply to Marion's question that ironically ties to one question I had for Jim, which is, have you ever thought about adding reverse mortgages to this, which clearly can be a tax efficient strategy as well. And that's one of the items that's listed in the survey. So if you don't see it there, I also have it in the chat box as well. So, all right, with that, so please participate is my ask and Jim's ask around that as well. All right, great. So Michael has an interesting question here, Jim. Is the primary source of tax alpha the progressive nature of the U.S. income tax system, or are there other large sources?
Yeah, the results that I've showed, I do see it as a result of the progressive nature. So in some of the earlier research that I had done with actually one of my colleagues from Santa Clara University, you can kind of think of over time, you really want to keep your especially your ordinary income and even your qualified income, you really want to keep it at a level that's fairly flat over here. You don't want to have a big spike. And I think that's probably obvious for all of you who are in practice, right? And you get a big spike, you're going to get a big tax bill. So you really want to kind of smooth that out over time. And that means thinking more strategically. That means not just thinking about next year, but hey, what is the next 5 years, 10 years, 15 years, 30 years, 40 years for that matter, going to look like? And so absolutely, I think that is the driver. It's our progressive system. That means the more income you draw down, it's going to bump you into higher and higher tax brackets. And a way to avoid that is to draw down those that are imposing that tax a little bit earlier so there isn't that large jump up. So hopefully that answers the question. But yeah, I think the short answer is yes. It is the progressive tax system.
Okay, great. Next from Charles, he's asking, how does your
Are you still there, Tom?
Sorry, I'm having the strangest phone problems. I got a new iPhone 13 Pro Max, and I've had the weirdest problems. So sorry, folks. It's literally dialing numbers, and I'm not even touching it. So, oh well. Okay, I guess I wish I was a millennial at times. But all right, next question from Charles asking, how does your work differ from Bill Reckenstein and his Income Solver software? Funny enough, Jim, you and I talked about this the other day. If you could comment on that, please.
Yeah, I've certainly run into Bill quite a bit in academic circles. I believe he's now officially retired from Baylor. I do find it interesting that two individuals who are focused on this are both sort of academics. So that's interesting. So Bill's software has been around for a while. I will say it is fairly expensive. I've talked to a number of practitioners who think it's maybe a bit on the pricey side, but it does offer some features that my software currently is not offering. Based upon what I know about his software, there are certainly a lot of similarities, but there are also some unique differences. So for instance, I really haven't had the chance to do enough due diligence to figure out, do RMDs really make sense when you look at the alternative of simply putting that money, not RMDs, but Roth conversions. Do Roth conversions really make a lot of sense to do, given you kind of can't undo them? And at some point, they'll pay themselves off. But what if the retiree passes away before that payoff period? That means there's sort of a loss there. So I know Bill's software does handle RMDs. At this stage, mine does not. So there is a difference. There. He also does a little bit more of a more of just I don't want to call it a crude search, but he basically looks at, let me just go up to a certain tax bracket and see if there's a benefit there. And then if that is not the right level, then I'll just go a different level, higher or lower. So he always assumes you consume right up to the top of a tax bracket. We've actually showed in our research that that is not always the best thing, because what can happen is you would lose the benefit in some of those later years. So in that respect, I'm pretty sure our optimizer can provide some benefits and opportunities that Bill's software cannot. However, again, there's still differences. So I believe if you do happen to live in a state that has income tax, and I'll use California as the example because I'm here, that is actually one of the questions I have for you all, which is, are state taxes critical to doing these kind of retirement plans? Now, I recognize if you live in Texas, right, you have no state taxes. So in that case, my software is sufficient. I believe Bill's software does handle state taxes. So there's an area where there's a trade-off, right? Maybe you want to include that. And so if that's critical, Bill's software might be ideal. And if it's less of an issue, then this software might be more appropriate. I haven't yet done, and it actually leads to a question of, could I do a side-by-side comparison of every feature that I have in my software against Bill's? And I actually haven't done that yet. But like I said, at sort of the big picture, there are certainly some overlap areas, but there are also some areas where the software does some different things and potentially is better on one case versus another case. So hopefully that kind of answers the question. I will say it's something that requires a bit of due diligence to really dig into the details. And I will say my goal is, because I am an academic, just like Bill, my goal is to try to communicate all of what the model is doing in a clear way, so that that kind of decision making for you as financial planners, or for you as accountants, or whatever field you might be coming from, you can make that informed decision on how the software can be best utilized for you in practice.
All right, great. Next from Michael, he's asking, is there a formula, Jim, for calculating the tax alpha as you define it, or is it a trial and error process of going back to the common rule with increased return assumptions until longevity bequest targets equalize? That's an interesting question.
Yeah, so it's actually an iterative algorithm. So for those of you that had either advanced high school or college level calculus, you learned of a thing called a root solver. The root solver is basically what goes behind the scenes in my calculation, that basically does a search. It searches for at what additional return in stocks and bonds would the common rule need to have in order to get the same longevity or the same. So it's automated. It's actually as efficient as it can get. But for those of you that might have already started to play with the calculator, you see it typically takes 30 to 60 seconds to run any plan. It's not just taking a guess and hoping it was right. It is quite rigorous, and it always has to converge to a solution. So yeah, the short answer is it's a mathematical process that's actually founded in calculus.
All right, great. Next from Brad, a good question. With the equation that you had for the after-tax value of the estate, and you had the C1.114, is that assuming that is taken equally over 10 years, or is the distribution all deferred until the end of the 10 years? So is it a periodic or at
Yep.
the end?
Yeah, that's a great question. And in fact, it was actually probably one of the biggest criticisms of this academic work, which was we waited until the end. We said, let's completely defer all that entirely. And so for the Roth style accounts, that certainly is acceptable, because at the end of those years, then you draw down the Roth assets and it doesn't have an impact on the tax bill. However, if you're the heir and it's a large amount of tax deferred assets, it's possible it could bump up their income taxes even more significantly, maybe a couple tax brackets. And it had been done once before by myself and actually a different colleague, where it was before the Secure Act. So you had basically a lifespan of the retiree. Since this number had never been provided, we felt like we need to make that assumption. But the short answer is it does assume, yes, you wait the full 10 years, and at the end of the 10 years, then you have to completely liquidate the account.
All right, good question from Jolene. Next, does the model let you handle different investment groups with different risk tolerance or investment strategy and related asset allocation? So you're able to kind of tweak those profiles, if you will, Jim?
Yeah, so risk is a great question. Right now, the way the model operates, because it is running an optimization, it's not running what's called a stochastic optimization. Stochastic optimization means now you have uncertainty occurring each year. That complicates the problem enough where that has still not really been a solvable problem from an academic perspective. It's an incredibly difficult numerical problem to solve. Even as fast as computers have gotten, they still aren't quite there yet. So what this model is doing is assuming some expected set of returns for each of those different assets. And of course, you could run different cases where, okay, stocks don't do quite as well, bonds do better, vice versa. It's not modeling the uncertainty in those returns. However, I recognize that, there is a risk because there's uncertainty in how long someone's going to live. There's uncertainty in stock returns, in bond returns. One of the tools I'm looking to build out next is going to be to address that specifically, which is what if you have that uncertainty? How does that uncertainty then get reflected into these kinds of decisions? So at this stage, the software is not doing that, but this is absolutely an area of future work because you're right. Given there's uncertainty, that might be a greater concern for a retiree than just how much wealth they think they're going to transfer. They want to know what is the risk of transferring that wealth. It could be higher, it could be lower. And in fact, I did some preliminary research on this a couple of years ago where it's going to be a distribution. So rather than getting, for example, a result that looks something like this where you get an extra 4 years, it actually may be between, say, 3 years and 7 years, and the distribution might be skewed, right? Or you might see a result that looks like this where the expected is 248,000, but it could be as high as, say, 500,000 or as low as 100,000, given the fact that we have uncertainty of not only retirees' age, life expectancy, but the uncertainty associated with those investment returns. So the short answer is that is not in the model right now, but it is an area that I'm considering for the future. And again, that's one of the reasons why I posed this Qualtrics survey to you. I'd love to hear if that's something that's really critical and important to you and you don't currently have tools that are doing that well or well enough. Would that be something that you'd want to be used or considered in an extension to this model? So thank you for the question.
Oh, sure. We have a lot of questions that have come in. And by the way, I just posted, you mentioned Mike Piper's free Social Security calculator. A lot of people ask about that. So I just posted that in the, question box as a response. I believe the right URL is opensocialsecurity.com, opensocialsecurity.com. And you'll find the calculator that Jim referenced. I know I've looked at that as well. It's been probably a year or so, but I know he's done a lot of very good work with that. All right, we're just going to try to keep moving here, Jim. We got a lot here. Jay is asking, and by the way, did you mention the prices? And I'm sorry, I've been trying to listen and monitor the chat room. Did you mention the prices? Did you go through that for your calculator? And again, the best place to find that, is that off the ETF Math Guy? You should see it on so I kept the pricing really simple because I really just need to make sure I cover the cost of hosting this on an external platform. So the way I have it set up currently, when you run the model, you'll get all the common rule results. If you want to see the optimal results after you see what the potential benefit is, there's a subscribe button, and I'm right now it's running a very simple 1-year subscription. In fact, let me show you what that would look like. I actually set up an account yesterday. It would look something like, let's see. So this is what the site looks like. If you click the sign in button, if you haven't registered, just register here. There's no cost to register. It just allows you to save some information. And so what you'll see is, you'll see something that looks like this, which is you can change your profile data. And if you subscribe, you'll see something that says you now have access to this calculator when your subscription started. It's a 1-year subscription. I give you the option to cancel the subscription after a few months if you don't want it. I'm not doing refunds. It basically just means you'd have access for it for the full year. This is what it looks like. And then if you were to go into the retirement income calculator, it gives you the ability to not only have a streamlined set of menus,
but it'll actually show you what those optimal results were. Otherwise, it's going to basically blur those images. It will still show you the information what you see here. It'll still tell you what the tax alpha is and the increased inheritance is. It just won't tell you what the first year decisions are. It won't show you exactly how the drawdowns change. To me, this is the big picture. If this convinces you this is worthy enough, then you can go ahead and subscribe. If not, you still have access to the results from the common rule. But the short answer, I guess, for the question of the cost, I set it to 90. I think it's $99.95 per year. That renews annually if you want to continue it.
Right, and then there is a premium, another version, which is $199. Do I recall that correctly, Jim?
No, I'm keeping it really simple. So the way it would work is there's a single subscription model. Now in the future, depending upon where the costs go for hosting this, for instance, after today's webinar, maybe I'll get a nasty gram from my hosting provider saying I'm using too much of their server resources. It's possible I'll have to figure out ways to bring in, help make sure I can offset those costs. But at least for now, it's a very simple model, which is if you want the optimal results after seeing what their potential benefit is, $99.95 a year. If you want to just use it for free or even register and provide profile data, you can go ahead and do that, and there's no cost.
By the way, I should have mentioned, geez, if you haven't signed up for Jim's ETF newsletter, he has a lot of great insights on ETFs and alternative investments, largely ETFs, but you definitely should subscribe to that. That's how I first found Jim, actually. So again, really well done on that. Okay, we're going to keep trying to get through some of the questions. Jim, I might ask you to come back and do more just a pure Q&A at some point because we have a lot of questions. Does the model account for Medicare Part B? Can you adjust the timing of Social Security? That's from Jay.
Yeah, so the second one's easy. Yes, you can adjust the timing for Social Security. It's actually pretty straightforward. So here's actually what the model looks like as its input. See if I can make this a little bit bigger for you all. So what you'll see here is this is information about your income from Social Security. So you can say you started at age 62. You can say you started at age 70 or anything in between. You say what that amount is. And you can also say the exact same thing for pension income. I started at 60, I started maybe much later, and what that would be. And then you can do the exact same thing for the spouse. Of course, I am assuming that whatever numbers you're putting in for the Social Security are the correct numbers. I'm not trying to cross-validate or confirm that that's something that's possible. You have to actually put in what that number would be. And of course, if you take that Social Security after your full retirement age, that number is going to get bigger. If you take it earlier, that number's got to be smaller. Nevertheless, this is something you do need to input. And in fact, I actually provide, you can always just hover your mouse over these little question marks if you want to see a little bit more suggestion. If it's not quite clear, what is this thing asking for? What am I looking for? In this case, it's asking you for the pre-tax Social Security income expected annually during retirement. And I say future values will be adjusted for inflation within the model. So that was the first question. The second one was Medicare Part B. I am not, so that was actually one of my questions I have for you all in my survey, which is, and I'll probably get, I know I'll get the acronym right, but it's IRMAA, Income Related Monthly Adjustment Amount. And I apologize if I got that wrong, but it is the additional cost associated with if your adjusted gross income or even the modified adjusted gross income is above a certain level. I have not yet included that in the model. But again, that's an area where if there's significant interest, I'd be happy to start including that as an upgraded feature for the future. So okay, hopefully that answers the question about Medicare. I think that was where it was leading.
Yeah, I think so as well. And again, Jay had that question. Michelle, you sort of have the same question, I think. Yeah, so again, hopefully that addresses that sufficiently. Next from Ted, he's asking, and Ted, I always love your style. Don't old folks often end up needing more income in later years? There's obviously that theory, that belief. And to me, it's not a question so much qualified versus non-qualified versus whatever, but your strategy underlying that is making certain that they have sufficient assets, be it in whatever account. But if you could comment on that, Jim, please.
Yeah, it's a great question. What happens, what do we expect in the future? I just read a quote from some of the work that Dave Blanchett's done, I believe he used to be at
Morningstar
before. I think he moved on to, he's at a new company now. He talks about we call it the retirement smile, which is initially you're going to spend more in retirement, and then it's going to kind of level off over time because you're maybe not able to travel as much, you're not going to be spending as much, and then it tends to go up maybe near the tail end because your medical costs will go up. So that's something I'm not currently, I include basically a flat amount. Now remember, that flat amount is adjusted for inflation. So if that's something that is of a concern, one thing to do is just simply go into the model and bump up the inflation amount. And that will automatically accommodate the fact that while things always get more expensive in the future because of inflation, increasing the inflation rate within the model will sort of do that indirectly. But you're right. Currently, I say there's a certain rate for the retiree and their spouse of after-tax income, and then there's a certain amount for the surviving spouse. Right now, the way the model would operate is you could say the surviving spouse suddenly needs more dollars as opposed to less dollars, but I am assuming currently it's a flat rate. Again, if that's an area that's of great interest, that's certainly a feature I could add and basically allow you to model, hey, maybe it goes down initially and then it kind of comes back up. Maybe it's more flat, maybe it's reversed. There's lots of different shapes you can imagine theoretically that would be possible. And I like to make the model as relevant as possible, so I certainly would appreciate suggestions along those lines.
Okay, great. So Chris, yes, on the inflation question, Jim just addressed that. You can see that in the input. Matt is asking, with the modified common rule, why does the pension plus Social Security decline every year after the first death?
Yeah, let's take a look at that. So I think,
and if you could just, as you're doing that, Jim, if you could just explain the modified common rule again, we've had that question as well.
Yeah, absolutely. So the modified common rule is basically the common rule, but it says I'm going to draw down not just my RMDs, but I'm going to draw down my RMDs up to the tax rate associated with my heir. So in the example of, let me see if I can bring it back up here. So in the example of this one, that's not the common, that's actually right here. The modified common rule says I'm going to look for what the tax bracket is of my heir. In this case, it's 25%. So you actually can't even see it. It's actually kind of up. It would be up here. So that means you can consume all the way to the top of the 24% tax bracket, which happens to be above the value here. So it says I'm going to go ahead and consume all the way up to here, this large amount of blue, because it's still more tax efficient for the retiree to use those dollars than to give them to the heir. The heir only sees 75 cents on the dollar, and the retiree is going to see, more than 75 cents on the dollar because they're paying taxes at, looks like the 22, the 12, the 10, and in fact, some of it's actually at the 0% tax rate. So I think that addressed the question about the modified common rule. Tom, can you bring up or repeat the first part of that question again?
The pension and the Social Security seem to decline after the first death.
Yes, so I do assume that the Social Security benefits are going to be passed on, provided the Social Security the Social Security benefits are larger for the spouse that passed away. If the surviving spouse already had a larger Social Security, I'm assuming they don't get any additional Social Security. So that's the first assumption. As far as the pension, now I'm trying to remember how I modeled the pension. I believe the pension did have a surviving spouse option, but remember also the pension, in fact, you can kind of see it here, it's going to decay over time because the pension is it's not adjusted for inflation. Which means over time it's going to have less and less buying power. It's going to contribute less and less to that 150,000. And I think that might be what you're seeing there.
Okay. Yep. Good question, Matt. Very astute there. So good question from Frederick here about the time value of taxes paid earlier. I mean, the whole idea of, sort of front loading and paying, how does the time value concept apply here?
Yeah, that's a great question. That's something I've been trying to think about when I write about this in some of the articles I publish, which is it's a little counterintuitive because at first you'd think, well, you just pay less in present value of taxes and that should help. But I don't think it quite works out like that. And I haven't been able to come up with a clear enough explanation to answer this question well enough. What I'm seeing right now are numerical results when I run it through the exact same set of tax rules. That, in the case here, the modified common rule, yes, you pay more taxes initially, but the effect on it allowing the other accounts to grow is more significant. And then it also ties back to just simply the equation that says, what is that wealth going to be worth? And so this is the trade-off of, is it better to have more left over in this, which then the heir has to pay taxes on? Or is it better for the brokerage account to get that step up in basis when it goes to the heir? And that's where paying a little bit of taxes might be more worthwhile earlier on, because then the heir gets this full step up in basis. This is truly at the cutting edge of research. I just read a portion of Wade Pfau's recent book that he put out on the retirement planning guidebook. This is still an open question. Like, how is that really working? I have the numerical evidence here showing it does work, but I really think it's the trade-off. It's the trade-off of, well, you can give your IRA assets to your heir, but they got to pay taxes on it. Or you could give your taxable account assets to your heir and they get to step up in basis. So it's a trade-off of, if you've got a highly appreciated ownership of, say, Google, right? You've got shares in Google, and if you start spending those shares, you're going to pay a lot in gains because they've had a significant gain over the last, say, 15 or 20 years. Obviously, when you give that to your heir, they get the step up in basis. They get a big tax benefit. It might be better to do that than it is to actually use the tax deferred account, or vice versa. And that's where it's not entirely clear to me when the optimization runs, if there's some intuition that we can build around that associated with the time value of those taxes. I'm not there yet. I haven't seen any academic who's been able to explain it very clearly. It is sort of it's maybe a counterintuitive result that doesn't quite have a good explanation yet. We certainly have evidence for it numerically, but the explanation you're looking for is truly cutting edge. I don't think it yet exists.
Okay, great. I'm just frankly just trying to scan a lot of questions. I think you commented on this before, but this is from Bob asking, do your calculations assume the sunsetting of the Tax Cut Job Act in 2026, right?
Yeah, so they do. Actually, it doesn't assume a sunset. Actually, the way I ended up modeling it, right or wrong, right? Models are like that. I have a component in the model that says, it's actually right in here. I said, what happens after the Tax Cut and Jobs Act? So I say, okay, this says they basically don't change. And you can say, well, that might be in 2026. What if it happens earlier? What happens if it happens later? So rather than saying it reverts to the old tax brackets, I'm saying, well, you can just go ahead and set, given the current tax rate, will they go up by, say, 40%? Or will they go down by 20%? I personally struggle with trying to guess what Congress is going to do. Everything I read says, my gosh, they have so many different options of what they can do. I thought, from a perspective, I'd rather say this is the model as a tax law currently exists. And if you think after a certain date, the tax rates are going to go up or down, you can go ahead and modify that right here. But I don't provide, and maybe this is something to include, I don't currently provide, what if it just reverts back to the old tax law? I actually did not do that. And maybe that's something that I should consider going forward in the future. My real challenge is if I start to really try to model all the potential changes in tax laws, the model gets so massive that it almost becomes unmanageable. So I had to make some assumptions, and here the way I accommodate that was, you can go ahead and change this. You can change it to plus 30%, whatever you think might happen in the future. But in the future it's uncertain. This is the way I've tried to address it.
Yeah.
So great question.
Exactly. Yeah, and so related to that, someone's asking, why did you use the marginal tax brackets and why not the effective rates, since you are measuring cash flow?
Yeah, so I really cared about the marginal rates because I want to know what every additional dollar was doing in terms of its impact on what the heir could potentially receive, or how much those dollars could be stretched out. So, for instance, on this slide, right, what I really cared about was, how these, try that again, sorry about that, fighting with my, There we go. What I really cared about in here was what was the additional tax I'm paying by, actually this is not the good example. There we go. How much additional tax, you're paying extra dollars in tax up here relative to tax that you paid here, relative to the tax you paid here. You're right, you can actually determine the effective tax. That sort of, from an optimization perspective, actually makes it harder to find. You'd rather see more of those discrete cutoffs from one tax rate to the other. It helps the algorithm better identify how to stay below it. So it's partly numerical, part just keeping the intuition behind the marginal rates, and staying below a certain marginal rate is ideal. So hopefully that answers the question.
Yeah. Okay, very good. This is more sort of a kind of a question, but I think something to consider as well, Jim, from Scott had to leave. But how would a more active management approach to taxable accounts where short-term capital gains and ordinary dividends create an annual income stream for retirees? How much influence would that have to modify the common rule?
Yeah, that's another great question. In fact, the area of direct indexing continue to get more and more popularity. In fact, it's actually an area that I'm considering for my next area of research, because it's grown in popularity, and the technology to enable it, and keep tracking error against, say, the S&P 500. If you just wanted to track it, has significant benefits. There has been some research in that recently. I have not tried to include that in the model, but you're absolutely right. The opportunity to realize short-term gains and have that offset your tax bill, and then realize long-term gains later on, there is absolutely a tax benefit for that. I do kind of look at them as separate, though, because those are more investment strategies of taxation, as opposed to, this is more drawdown decisions. So they're certainly within the same area of taxation, but they're sort of separate decisions, and they can be implemented separately, or they can be implemented together.
Sure.
So given those two areas of research have been separate, there may be an integration, and maybe this is an area to look at. Are there synergies between the two of them, or are they still pretty much, they don't really affect one another? That's really an unknown. I don't know the answer. I haven't seen anything in the literature suggest if there's any kind of synergies there. My gut is telling me there's probably not a big synergy, but certainly there is a possibility of something going on there.
Good question from Barbara asking, does the program distinguish between retirement assets and inherited retirement assets that may require an RMD before retirement?
Oh, that's a great question. Thank you, Barbara. No, so I have not assumed there are any assets that had an RMD associated with them because they were inherited. That actually may be an interesting thing to include, right? As retirees receive assets as an heir, there may be that schedule of required distributions that they'd have to follow. I do not include. I guess one way I would look at that is it's sort of you can think of it as simply a lump sum, as opposed to trying to stretch it out. Additional dollars that would require, quite frankly, an update to a plan. I've had a number of practitioners ask me, how often would you look at a plan like this? I'd say, well, I would think you'd want to look at least once a year. Each year, you're going to see different results of how the markets perform. You'll get a better assessment on the longevity of the retiree. And even just from a forecasting perspective, the less in the future you're trying to go out, the more resolution you'll have on your predictions. So I would think at least once a year, someone would want to revisit this. And that means that in 1 year, you received a large bulk of an inheritance, you'd want to include that as an increase to, say, some of the account values.
Okay. I would say we continue to have a lot of questions about the Roth conversions, and does the program handle that, and Sridhar and many others. And again, today it does not. Correct, Jim?
That's correct. That's correct. Today it does not. Yeah. And in fact, I guess what I'll add is some of the research I've seen from one of the faculty members, who's actually one of my colleagues, another different colleague from Santa Clara. He's actually done some research that shows it doesn't really look, because to keep things apples to apples in a Roth conversion, you have to be careful that you really compare things directly. You can't compare just keeping money in cash accounts versus doing a conversion that is then invested in stocks. And so he's looked at the idea of there's going to be some break-even point. that at some point the Roth conversion will pay off. The question is that break-even point realistically going to happen within the retiree's timeline before they end up passing away? Or is there some strategic benefit to the heir? Say the heir is, a plastic surgeon, or the heir is incredibly wealthy. You probably would want to give them Roth assets before you give them something like IRA assets. It's a really complex problem. I haven't tried to dig into the details well enough yet, but the short answer is, at present, this model does not do any Roth conversions. Or if you do them, you'd have to include those in your updated count values for Roth, as well as updated deficits that come out of the taxable account in order to pay for it, which means now you're selling taxable account dollars, taxable account assets, paying taxable gains on that. So there's a lot of inner working pieces. I have not tried to include that here yet. But again,
Jolene,
fill out the survey. Yeah, fill out the survey. I put them in rank order. If you think that's number one, put that one right at the top. I would love to hear from you on that.
Okay, so Jolene brought it to my attention, Jim. The ranking feature in the survey doesn't seem to be working, and I'm trying that myself, and I can't seem to get it to take my input. So I'm hovering over the items and again, just trying to do the input. So we can send it out again.
Yeah, so you should be able. So you should. Yeah. So what you do is you have to hold your mouse button down and then just drag it up. So for instance, if I wanted to say, I really want to see estate taxes as number one, I just hold it and drag it down. Oh, you know what? Actually, I disagree. I think reverse mortgages should be number one. I don't really care about rental income. Let's drop that down to the bottom. And so, yeah, if you just hold it, I don't know how well it'll work if you have an iPad or a phone, but on a desktop computer, yeah, just hold it down and just drag it around, and that will take you right to putting them in the order that you feel is most appropriate.
Okay, folks, you can do it now if you like, but also I'll send it out in an email, Jim, to all the attendees, and we'll send it out as part of the follow-up. Good question, and we're coming close to 1:30. Thanks, Jolene, for pointing that out. But this is from Bob. Bob, good to see you on. There are thought leaders in the industry, Wade and Tom Hegna, that talk about using life annuities to replace a portion of one's bond portfolio to add alpha. What are your thoughts on that?
Basically selling off maybe a portion of the bond portfolio and buying like an immediate annuity. That's an area that really this software was not really designed around, but I'd love to be able to provide some comments about it. So this is more of a risk question. Some individuals really want to have a larger amount of guaranteed income to make sure that the risk of running out is extremely small. Others are thinking, well, you know what? I already have plenty of assets. I don't think I'm going to run out. When I purchased that annuity, that immediate annuity, if we get that stream of income, my heirs, depending upon how the annuity is structured, may not get anything. There may not be any potential value to that at the end of the day once you pass away. So to me, it's a trade-off. It's a trade-off of how much risk do you want to take? How much of your legacy do you want to pass on to your heirs in terms of just dollars? And to me, it's a challenging question because it's something that really goes to the core of how someone thinks about the legacy and their concern about potentially running out of dollars when they go into retirement. The last thing I'll say about that is, and I think I've even seen Wade write about this, is that there's not a lot of those available that adjust for inflation. And I think that's probably the biggest challenge, which is especially in today's environment where inflation is here. Hopefully it'll go away soon, but with supply chain issues going on, and now we've got a land war in Europe, inflation seems like it might be around for a while. How do you deal with that inflation? I'm personally not convinced that buying a fixed income annuity that pays off each year but loses its buying power in the next 10, 15, 20 years over a retirement horizon is perfect. I don't think it's the perfect answer, but I also don't think there is a perfect answer. I think it depends largely on the individual. I also agree with what Wade wrote in his book about pension. Social Security is one of the best immediate annuities you can get because it's inflation adjusted and it's backed by the U.S. government. So I would love to see if the industry can provide things that are more like Social Security that adjust for inflation. I could see that would have a much stronger, I think it would resonate much more with those individuals that are concerned about not just about longevity risk, but inflation risk. So anyway, that's my thoughts on this. hopefully you find that helpful.
Oh, okay. And Barbara, I'm sorry, it took me a minute to get to the question. So when you're modeling cases in the calculator, are you able to do that for couples that are not married, for example? It might be a parent and a child, or different scenarios than just a traditional married couple, if you will.
Yeah, so right now I only have the model assuming you're either filing as married, filing jointly, or that you're filing as a single. If you're referring to the case of like someone with, I'm thinking like the example of like a head of household, I have not included head of household. Based upon what I've seen in terms of tax returns filed by retirees, there's not many of them, so I haven't included that. If it's an individual like a retiree who's caring for a child, and they're using the standard attorney, I'm not a CPA. What I know about tax law is me talking to CPAs, me talking to tax attorneys, and me reading IRS bulletins. So I want to caveat that. My understanding is that that individual would be filing their taxes still as a single, perhaps as a head of household. So if it's being filed as a single, it absolutely, model can accommodate that. If it's head of household, I currently don't have that included. Although, again, that would be maybe an option of something that if there really is strong interest, I could make the investment and we could potentially include that in a future version of the software.
Okay, we're going to get to Frederick's question. He's commenting, Jim, you have written that the progressive tax code makes your scenarios and calculations at best an approximation. Are you now modifying that view?
I'm sorry, could you say that? Can you repeat that question for me, Tom? I want to make sure I understand it.
Frederick is asking that given that you have written that the progressive tax code makes your scenarios and calculations at best an approximation, are you now modifying that view?
So I don't, so anything in the future is going to be an approximation because we don't know what the future tax rates are going to be. So any model is always going to be an approximation of what we think is going to happen. As far as me changing my view, it's an approximation based upon our best guess of what the future holds. I don't think we're going to change our progressive tax system within the U.S. anytime soon. So I think, the way the model works, where it tries to keep you away from those higher tax brackets, is still a sound direction to go. And I don't see any model, whether it's my models or Bill Richtenstein's or any, there's a few other models out there that are trying to do this. I don't see any of them steering clear of that. In fact, the reverse, I would say, which is my article is looking at the progressive tax system, not just in the U.S., but all over the world. The progressive tax system is not a U.S. only system. Progressive taxes exist in other countries as well. My research in that area is somewhat preliminary, but thankfully I have a colleague at USC who actually was actually born and raised in Germany. And so we're starting to look at, do these findings about how the progressive tax system and the implications of that for tax efficiency and retirement, how relatable are they to, say, Western European countries, to other countries in the world that have a similar type of system? So I guess I'm not discarding the progressive tax system. I'm just trying to have a model that best represents how it would behave and how it would affect taxes in the future for a retiree, and finding strategies that will draw down assets in a way that would be most tax efficient. And again, by tax efficient, I mean two things: either extending the longevity of the portfolio or increasing the amount of dollars going to an heir.
All right, great. Lots of feedback on the model should address IRMAs, where you have the higher, because you're in a higher tax bracket. There's a lot of positive on that, or a lot of suggestion that they'd love to see that, Jim, just to share that. Okay, great. Okay. I really appreciate you staying on the extra time here. I'm mindful of your time. It's 1:34 Eastern. So really, on behalf of everybody, Jim, thanks for sharing your research here and what you've done. Really a lot of great insights, and really, again, great to have you on. Love to have you back, as I mentioned before we kicked it off. So, and love to, as you continue to develop things, certainly would love to be able to share your survey and your outreach to my community, and I'm sure they'd love to weigh in on what you're doing. So please feel free to connect with me around that as well. So with that,
wonderful.
Again, on
thank
behalf
you.
of everyone,
And thank you, Tom, for having me. Thank you for all the great questions. I really, I can tell you as an academic, I really appreciate the feedback I get from practice, because I really think academics, we're often at risk of doing things because that's what the ivory tower is interested in, but in practice, it may not be all that relevant. So the feedback I've gotten here today has been incredibly valuable, and I want to thank everyone for that.
Great, wonderful. All right, well, everybody, thanks for hanging on, and hopefully, as always, please complete the survey. I know you found it helpful, but give us feedback in the survey as well that you'll see pop up in a minute. And then, of course, if you haven't checked out the upcoming webinars for tomorrow, for Thursday, we have some great sessions. Tomorrow's iClass, again, with Brad Gornto, who's phenomenal. If you have clients that are gifting $10,000 or more a year, you want to jump on this session tomorrow to learn how they could get an immediate tax savings on this year's return based on their future gifting. I think it's a brilliant strategy. And then we have number one speaker ever so far, Tiffany Cross, on FICO and credit scores, along with a colleague, Joel Brown, on Thursday. Again, a lot of new stuff happening even in the area of FICO and credit. And then, of course, next week we have a lot of good things as well, to include ethics CE next Thursday with my friend Jeff Ratner. So again, as a subscriber, you get ethics as part of that. So with that, again, thanks to everybody for joining. Jim, again, appreciate it, and I will be in touch, and all the best.
Wonderful. Thank you, Tom. Thank you, everyone.